For centuries, traders have sought to unravel the mysteries of the markets. They searched for tools and techniques to gain an edge, to anticipate price movements, and to make informed trading decisions. Among these tools, candlestick patterns have emerged as a timeless and powerful method of technical analysis. Originating in Japan centuries ago, candlestick charts offer a visual language that transcends borders and languages. They provide traders with insights into the psychology of the market, revealing the balance between buyers and sellers. Candlestick patterns are not merely abstract formations on a chart. They are a reflection of the emotions, decisions, and actions of countless traders who participate in the market. By learning to read these patterns, we gain access to a wealth of information that can enhance our trading strategies. Just as a seasoned sailor reads the wind and waves to navigate the seas, a skilled trader relies on candlestick patterns to navigate the often turbulent waters of the financial markets. In the following sections, we will delve into the fascinating world of candlestick patterns. We will explore their basic structure, unravel their hidden meanings, and learn how to interpret them effectively. Whether you are a novice trader just starting your journey or a seasoned professional seeking to refine your skills, understanding candlestick patterns can be an invaluable asset in your trading arsenal. Before we can decipher the messages conveyed by candlestick patterns, it is crucial to understand the basic anatomy of a candlestick. Each candlestick on a chart represents the price action of a specific time frame, whether it's a minute, an hour, a day, or a week. A candlestick consists of four key elements: open, high, low, and close. The open price is represented by the bottom of the candlestick's body if the price went up during the time period, and the top of the candlestick body if the price went down. The high price is marked by the top of the upper shadow or wick. The low price is marked by the bottom of the lower shadow or wick. The close price is represented by the top of the candlestick's body if the price went down during the time period, and the bottom of the candlestick body if the price went up. The relationship between these four elements determines the shape and color of the candlestick, which in turn provides clues about the balance between buying and selling pressure. The body of the candlestick, the thick part, represents the range between the opening and closing prices. A long body suggests a strong price move, while a short body indicates less price movement. The color of the candlestick body typically indicates whether the closing price was higher or lower than the opening price. A white or green candlestick usually signifies a bullish period where the closing price was higher than the opening price. Conversely, a black or red candlestick typically indicates a bearish period where the closing price was lower than the opening price. The thin lines extending above and below the body are called shadows or wicks. They represent the price extremes reached during the trading period. Long upper shadows suggest buying pressure that was unable to sustain the high, while long lower shadows indicate selling pressure that was met with buying support. In the world of trading, the terms bullish and bearish are used to describe the overall sentiment or direction of the market. Bullish sentiment implies optimism and an expectation of rising prices, while bearish sentiment reflects pessimism and an anticipation of falling prices. Candlestick patterns often reflect this sentiment by visually depicting the struggle between bulls, buyers, and bears, sellers. Bullish candlesticks, typically depicted as white or green, indicate that buyers were in control during the trading period. These candles often have longer bodies and shorter shadows, reflecting strong buying pressure. Bearish candlesticks, on the other hand, are usually black or red, signaling that sellers dominated the trading session. These candles tend to have longer lower shadows and shorter upper shadows, reflecting selling pressure that pushed prices lower. By observing the color and shape of individual candlesticks and, more importantly, patterns formed by multiple candlesticks, traders can gain valuable insights into the balance of power between buyers and sellers. This information can then be used to identify potential trading opportunities. While candlestick patterns involving multiple candlesticks often provide more reliable trading signals, single candlestick patterns can also offer valuable insights into market sentiment and potential reversals. These lone wolf patterns can act as early warning signs, alerting traders to shifts in the balance of power between buyers and sellers. Here are some key single candlestick patterns and their implications. Doji. A doji candlestick has a very small or non-existent body, indicating that the opening and closing prices were very close or even the same. This pattern suggests indecision in the market, with neither buyers nor sellers able to gain a clear advantage. A hammer candlestick has a small body at the upper end of the trading range and a long lower shadow. It typically forms after a downtrend and suggests that sellers pushed prices lower, but buyers emerged to push prices back up, potentially signaling a reversal to the upside. Inverted hammer. An inverted hammer is similar to a hammer but has a small body at the lower end of the trading range and a long upper shadow. It also forms after a downtrend and suggests that buyers attempted to push prices higher, but sellers pushed prices back down. However, the long upper shadow indicates potential buying pressure that could lead to a reversal. Shooting star. A shooting star candlestick has a small body at the lower end of the trading range and a long upper shadow. It typically forms after an uptrend and suggests that buyers pushed prices higher, but sellers emerged to push prices back down, potentially signaling a reversal to the downside. Spinning top. A spinning top candlestick has a small body located in the middle of the trading range, with upper and lower shadows of roughly equal length. This pattern suggests indecision or a balance between buying and selling pressure. Section 5. Strength in numbers. Dual candle patterns unveiled. While single candlestick patterns can offer valuable clues, dual candle patterns formed by the combination of two consecutive candlesticks often provide stronger and more reliable trading signals. These patterns reveal shifts in momentum and potential trend reversals with greater clarity. Let's explore some important dual candle patterns. Bullish engulfing. The bullish engulfing pattern consists of a small bearish candlestick followed by a larger bullish candlestick that completely engulfs the body of the previous candle. This pattern signals a potential reversal of a downtrend as buyers have stepped in with significant force, erasing the previous day's losses. Bearish engulfing. The bearish engulfing pattern is the opposite of the bullish engulfing, with a small bullish candlestick followed by a larger bearish candlestick that engulfs the previous candle's body. This pattern suggests a potential reversal of an uptrend as sellers have taken control, pushing prices significantly lower. Bullish harami. The bullish harami pattern consists of a large bearish candlestick followed by a smaller bullish candlestick that is completely contained within the body of the previous candle. This pattern suggests that the selling pressure may be weakening and a reversal to the upside is possible. Bearish harami. The bearish harami is the opposite of the bullish harami, with a large bullish candlestick followed by a smaller bearish candlestick contained within the previous candle's body. This pattern suggests that buying pressure may be waning and a reversal to the downside is possible. Tweezer tops and bottoms. Tweezer patterns are formed when two consecutive candlesticks have very similar highs, tweezer top, or lows, tweezer bottom. These patterns suggest a potential reversal as the market is unable to break through a certain price level. Section 6. The power of three. Triple candle patterns and their secrets. Triple candle patterns, formed by a sequence of three consecutive candlesticks, provide even stronger confirmation of potential trend reversals and continuation. These patterns offer a more comprehensive view of the battle between buyers and sellers, revealing subtle shifts in momentum that may not be apparent from single or dual candle patterns. Let's delve into some significant triple candle patterns. Morning star. The morning star pattern is a bullish reversal pattern that typically occurs at the end of a downtrend. It consists of a long bearish candlestick followed by a small-bodied candlestick, either bullish or bearish, that gaps lower, and finally a long bullish candlestick that closes well within the body of the first candlestick. This pattern suggests that selling pressure is weakening and buyers are starting to take control. Evening star. The evening star pattern is the bearish counterpart of the morning star and typically occurs at the end of an uptrend. It consists of a long bullish candlestick followed by a small-bodied candlestick that gaps higher and finally a long bearish candlestick that closes well within the body of the first candlestick. This pattern suggests that buying pressure is waning and sellers are starting to dominate. Three white soldiers. The three white soldiers pattern is a bullish continuation pattern that signals strong buying pressure. It consists of three consecutive long-bodied bullish candlesticks that close near their highs, with each candlestick opening within the body of the previous candle. This pattern indicates a strong upward momentum. Three black crows. The three black crows pattern is the bearish counterpart of the three white soldiers and signals strong selling pressure. It consists of three consecutive long-bodied bearish candlesticks that close near their lows, with each candlestick opening within the body of the previous candle. This pattern indicates a strong downward momentum. Three inside, up, down. The three inside up and three inside down patterns are reversal patterns that signal potential trend changes. The three inside up pattern is bullish and consists of a long bearish candlestick followed by a smaller bullish candlestick that is contained within the previous candle's body, and finally a bullish candlestick that breaks above the high of the first candlestick. The three inside down pattern is bearish and follows the opposite sequence. Section 7. Context is key integrating candlesticks with market trends. While candlestick patterns can provide valuable trading signals, it's crucial to remember that they are most effective when interpreted within the context of the overall market trend. Candlestick patterns should not be viewed in isolation, but rather as part of a broader technical analysis. For example, a bullish engulfing pattern at the end of a prolonged downtrend carries more weight than one that occurs during a period of consolidation or a sideways market. Conversely, a bearish engulfing pattern at the peak of an extended uptrend is a stronger sell signal than one that appears during a pullback within an uptrend. To effectively integrate candlestick patterns with market trends, traders often use additional technical tools such as trendlines. Trendlines are used to connect swing highs and swing lows, helping to visualize the direction and strength of the prevailing trend. Moving averages. Moving averages, such as the 50-day and 200-day moving averages, can help identify support and resistance levels, as well as confirm trend direction. Indicators. Momentum indicators, such as the Relative Strength Index, RSI, or the Moving Average Convergence Divergence, MACD, can help assess the strength of a trend and identify potential overbought or oversold conditions. By combining candlestick patterns with these additional tools, traders can develop a more comprehensive view of the market and make more informed trading decisions. Section 8. Candlesticks alone are not enough. The need for confirmation. While candlestick patterns can provide valuable insights into market sentiment and potential trading opportunities, it's essential to remember that they are not foolproof. Candlestick patterns should not be used in isolation, but rather as part of a well-defined trading strategy that incorporates other forms of technical and fundamental analysis. Here's why confirmation is crucial. False signals. Candlestick patterns can sometimes generate false signals, especially in choppy or sideways markets where clear trends are absent. Subjectivity. The interpretation of candlestick patterns can be somewhat subjective, and different traders may perceive the same pattern differently. Market noise. Financial markets are constantly bombarded with news, events, and economic data, all of which can create noise that obscures the true market sentiment. To mitigate the risk of false signals and increase the reliability of candlestick patterns, traders often look for confirmation from other technical indicators, such as volume. Increasing volume on bullish candlestick patterns and decreasing volume on bearish patterns strengthens the signal. Overbought or oversold conditions. Confirmation from momentum indicators like the RSI can help identify overbought or oversold conditions that may increase the likelihood of a reversal. Support and resistance levels. Candlestick patterns that occur near significant support or resistance levels are generally considered more reliable. By seeking confirmation from other technical indicators, traders can filter out false signals, reduce subjectivity, and increase the probability of successful trades. Section 9. Mastering candlesticks, a journey, not a destination. Mastering candlestick patterns is not a destination, but rather a journey of continuous learning and refinement. The more you study and apply these patterns, the more proficient you will become at interpreting their subtle nuances and using them to your advantage in the markets. Here are some tips to enhance your candlestick pattern recognition skills. Start with the basics. Begin by memorizing the most common candlestick patterns and their basic interpretations. Focus on understanding the underlying psychology behind each pattern. Practice regularly. The more you practice identifying candlestick patterns on historical charts, the better you will become at recognizing them in real-time trading scenarios. Use multiple time frames. Analyzing candlestick patterns on multiple time frames can provide a more comprehensive view of the market and improve the accuracy of your trading decisions. Keep a trading journal. Recording your trades, including your rationale for entering and exiting positions, can help you identify patterns in your trading behavior and improve your overall performance. Backtest your strategies. Before risking real capital, backtest your trading strategies based on candlestick patterns using historical data to assess their effectiveness and identify potential weaknesses. Remember that mastery of candlestick patterns takes time, dedication, and a willingness to learn from both your successes and failures. Section 10. The enduring legacy of candlestick patterns. Despite the advent of sophisticated trading algorithms and high-frequency trading, candlestick patterns have retained their relevance and value in today's fast-paced financial markets. Their enduring legacy is a testament to their ability to provide insights into market psychology and offer a timeless language that transcends cultural and technological barriers. Candlestick patterns continue to be widely used by traders of all levels of experience, from individual investors to institutional fund managers. Their visual nature makes them easy to understand and interpret, while their ability to reveal subtle shifts in market sentiment makes them an invaluable tool for technical analysis. As we move forward in the ever-evolving world of finance, candlestick patterns are likely to remain an integral part of trading strategies for generations to come. Their ability to provide a glimpse into the collective psychology of the markets ensures their continued relevance in an increasingly complex and interconnected trading landscape. Section 11, a final word: trade smart, trade wisely. In conclusion, candlestick patterns are a powerful tool for any trader seeking to navigate the complexities of the financial markets. By understanding the anatomy of candlesticks, recognizing bullish and bearish patterns, and interpreting them within the context of market trends, traders can gain a significant edge. However, it's crucial to remember that candlestick patterns are most effective when used in conjunction with other technical indicators and as part of a well-defined trading strategy. Always prioritize risk management and never risk more capital than you can afford to lose. Trading involves inherent risks, and past performance is not indicative of future results. By combining knowledge, discipline, and a commitment to continuous learning, you can increase your chances of success in the exciting and challenging world of trading.